Welcome back. In our last session, we prepared our closing entries. And once we prepare our closing entries and journalize them and post them to our ledger, we're ready to prepare what's called the post-closing trial balance. And the purpose of the post-closing trial balance is to verify that the ledger is in balance at the beginning of the next period. And here we can see the post-closing trial balance for Net Solutions. You can see the only accounts that's listed on this post-closing trial balance are our permanent accounts or our balance sheet accounts. Our assets, which includes cash, accounts receivable, supplies, prepaid insurance, land, office equipment, and accumulated depreciation. Our liability accounts, which includes accounts payable, wages payable, and unearned rent. And then our capital account, which in this case is Chris Clark Capital. And you can see that we have a debit balances total $29,545, and our credit balances total $29,545. So we can see our books are in balance for the beginning of the next period, and that all of our temporary or nominal accounts have been closed out or now have a zero balance. So what we want to do at this point is just describe the accounting cycle. In these 4 chapters, we went all the way through the accounting cycle. And so what we want to do is just describe the accounting cycle, the accounting process that begins with analyzing and journalizing our transactions and ends with preparing the accounting records for the next period's transaction is called the accounting cycle. And there are actually 10 steps in this cycle. And we're going to review those steps at this point. Step number 1 is transactions are analyzed and recorded in the journal. Step number 2 is we take those transactions and post them in our ledger. Remember, our ledger is our collection of all of our accounts. So we have a ledger for cash, we have one for accounts receivable, one for land, one for supplies, one for each one of our asset accounts, one for each one of our liability accounts, which would be accounts payable, wages payable, unearned rent, and any other liabilities that we have, and then our capital account. And then each one of our, of course, the owner's drawing account, each one of the revenue accounts, and each one of the expense accounts. That makes up our ledger. So we journalize our transactions, record them in the journal, and then post those transactions to the ledger. And then once we do that, we can prepare our unadjusted trial balance, and then we take a look at that unadjusted trial balance and see which one of those accounts need to be adjusted and start gathering the data together and analyzing that data for the accounts that need to be adjusted. Step number 5, we can use a optional end of the year spreadsheet. If we do that, it's normally a 10-column spreadsheet that we use. And then step number 6 is our journal entries are journalized and posted to the ledger. And then once we do that, we can prepare our unadjusted trial balance and then prepare our financial statements, then do our closing entries, journalize and post those to the ledger, and then do our post-closing trial balance, which we do to make sure that we're in balance for the beginning of the next period. Now we're going to take a look at an example exercise 4-6. And here they list 8 of the 10 steps. First step, again, transactions are analyzed and recorded in the journal. That's listed. Second step is posting those transactions to the ledger, and that's listed. The third step is prepare an unadjusted trial balance. Now you see that that step is missing. So that's one of them that we're missing. Step number 4 is shown here. Adjustment data are assembled and analyzed. And then step number 5, an optional end of the year spreadsheet or worksheet is prepared. And then step number 6, adjusting entries are journalized and posting to the ledger. And once we do that, we can prepare our adjusted trial balance. And you can see that that step is also missing. And then step number 8 is financial statements are prepared. Step number 9, closing entries are journalized and posted to the ledger. And step number 10, a post-closing trial balance is prepared. And on this slide, you can see those 2 steps are listed. Now what we want to do is just take a quick look at the accounting cycle for one period and and see how the information flows through. First thing again is we post our journal entries, and these two slides just show our journal entries for April Kelly Consulting. And then of course we know once we journalize those entries, we have to post them to our ledger. And then once our ledger is up to date for the period, we can prepare our unadjusted trial balance. And then once we do that, we look at our unadjusted trial balance and see which one of those accounts need to be adjusted and start collecting that data. And then step number 5, we can use this optional end of the period spreadsheet, putting our unadjusted trial balance figures in the first 2 columns, our debit and credit columns, and making sure that they balance. And then we, from this worksheet, we can do our adjustments and then prepare our adjusting entries for the period, journalize and post those to our ledger. And then once we do that, we can prepare our adjusted trial balance for the period. And then once our adjusted trial balance is prepared, we can prepare our financial statements, of course beginning with our income statement, and then we move to the statement of owner's equity, and then prepare our balance sheet for the end of the period. And once our financial statements are prepared, we can prepare our journal entries, transferring our revenue accounts to the income summary, and then our expense accounts to the income summary, and then transferring the balance of the income summary to our capital account, and then closing out our drawing to the capital account as shown here. Those are our 4 entries: revenue, expenses, income summary, and drawing. And then once we journalize and post our closing entries, we can prepare our post-closing trial balance to check to make sure that we only have permanent accounts that have balances in them and that our debits equal our credits. And this is just these next few slides just show our balances in our ledgers. These all have account balances because they're permanent account or balance sheet accounts. And everything on this one's a permanent account or a balance sheet account, with the exception of the drawing account and the income summary account. And you can see that they have been closed out to the capital account. And then this slide represents our just a second. This slide represents our well, it looks like I've got the same slide in here twice. This slide represents our expense accounts, and you can see that those are closed out. And so all we need to do now is just explain what a fiscal period is and a natural business year. An annual accounting period adopted by the business is known as its fiscal year, and each time a business is set up, its fiscal year is determined at that point and normally does not change. When a business adopts a fiscal year that ends when the business activities have reached the lowest point in its annual operation, that fiscal year is called a natural year. And most businesses do close out their fiscal year and their natural year or actually coincide. We know that retail businesses normally their lowest period is after Christmas, of course, and that's when their fiscal year ends. Construction industry, their lowest part of the year is at the end of the year. So their natural year and fiscal year usually are the same, and it's a calendar year. However, other businesses may have a fiscal year, like the school operates. We close our fiscal year at the school on June 30th because that's our lowest point. The summer quarter enrollment is the lowest point of the year for us, and that's actually the beginning of our next fiscal year. One of the things we do in accounting is we do collect financial history of the business so that we can see how things are going throughout the year and compare it to prior years so that we can make improvements and not let things creep up on us and keep us from making adjustments in our business as we need to. So timely financial information is very important and critical to a business. And that concludes chapter 4, and I hope you've enjoyed it and that you have a great day. Thank you.